Welcome back to the show. Today we have Scott Cooper. He's a managing partner and Andreessen Horowitz. Scott, welcome back to the show.
Thanks for having me. Glad to be here.
Yeah, I'm excited to have you back on the show. You did the radio version a couple of weeks ago. They're actually going to air on the same day as this. But
Right.
I'm super, super excited to have you back on the show. But maybe before we get into the book and all the stuff you're doing, do you maybe want to give us a quick background on yourself and kind of where you grew up, where you went to school, and how you got to Andreessen Horowitz?
Absolutely. Yeah, I'll give you a quick rundown. So I actually grew up in Houston.
Okay.
Came out to California for the first time when I was lucky enough to go to Stanford for school.
Very cool.
And, I decided as long as I was in California, I may as well learn something about the technology business, and found my way to Mark Andreessen and Ben Horowitz in 1999 when they started a company called LoudCloud.
Right.
Which many people probably haven't heard about, but we were trying to build Amazon Web Services, is essentially what we were trying to do, and we were probably about 10 years too early, unfortunately. We ran that business. We ultimately sold it to Hewlett Packard, and we started this business in 2009. So I've been here at Andreessen Horowitz for about 10 years now. Actually, June is our 10th anniversary, and just having a blast.
Very cool, man. No, that's really great. So walk me through what you guys do at Andreessen Horowitz, because it's a little bit different than the traditional VC firm.
Yeah, so our main goal is we hope to find great young entrepreneurs who are starting out and have an idea, and people like the Airbnb founders, for example, or the founders of Slack. And our job is to hopefully provide capital to them initially, but then also, quite frankly, to provide them help and assistance as they build the business. So what we've done that's different from the rest of the venture business is we have about 160 people today.
Wow.
And most of those people work on what we call a post-investment side. So they are working with our entrepreneurs to help them around sales enablement or PR and marketing, or kind of hiring executives or technical engineers. And so we view our job as to be important coaches and sponsors for our portfolio companies, but also to find ways in which we can lean in and hopefully help them accelerate the growth of their business.
Very cool. So you wrote a book. What's the book called, and what made you actually decide to write the book?
Yeah, the book is called Secrets of Sandhill Road, Venture Capital and How to Get It. It's coming out on June 4th. The reason I wrote it is I've been in the technology business for about 25 years now. Initially, as I mentioned, kind of in the startup world, and then now for the last 10 in the venture business. And what I just kept finding was there was a series of questions I kept getting from entrepreneurs that, kind of drew on a lot of the experience I had over that 25-year period. And I started kind of, writing a little bit in the form of blog posts, and then I just realized there was more to say and decided it probably made sense to go ahead and put it all down on paper.
No, that makes total sense. And the thing, and I told you this before in the radio interview, but what I love about the book is I don't come from a financial background. I'm kind of more on the design side. And the thing that I took away from the book is it got me thinking a lot about not only what you guys think about, but what a lot of the other people, maybe in upper management, are thinking about as well when raising capital, right? And I think a lot of people don't think about that. They're like, well, I don't really care. It has nothing to do with me because I just work here. But it's nice to know what management is thinking about, and what you guys are thinking about on the VC side of things, because it's way more complicated than I think a lot of people realize. So do you want to elaborate on what you guys kind of think about, and what people need to think about when raising venture funding, and maybe if it's even for them or not?
Yeah, that's a great point. And I'm glad actually you took that away, because I agree with you, which is the book is not just written for entrepreneurs who want to start businesses, but it's really written for anybody who's curious about this ecosystem and how it works. And I think you're right. If you're going to go join a startup company or interact with startup companies, understanding how they work and how the financing partners work is really an important piece. So maybe just to kind of rewind a little bit, I think the way to think about what we're doing is, again, if you think about what we're trying to build, is at success, we hope we can fund companies that can ultimately go on to be important standalone and hopefully public companies at some point in time. So that means, these companies have to be going after very big markets in order to be able to hopefully achieve those types of outcomes. And a lot of what we're doing at the early stage, which might surprise people, is we're really heavily focused on the aspects of team, quite frankly, even more so than some of the aspects of the actual product that team is building. And the reason I think that's important is we know that the products are going to evolve over time. And, we use this word pivot that you may have heard in this industry, which is a very polite way of saying, kind of we screwed up and now we got to try something different. And we recognize that. And so that's why we're so focused on the team itself, because we want to understand the resiliency of that team, the thinking of that team, and how they will kind of manage through in those inevitable pivots, even more so than kind of what the initial product idea is for the business.
Yeah, no, that makes a lot of sense. So I'm curious though, how do people actually decide whether they want to go for VC funding or maybe bootstrap or maybe get some seed funding or something else? Because it can get pretty complicated pretty fast.
Yeah, no, that's true. And again, I hope one of the things the book does, hopefully, is kind of demystify that question, because I think certainly if you live out here in the Valley, you hear about VC all the time. So you might assume, quite frankly, that's the only form of capital for many of these businesses. But I think the way to think about that question is, what are you trying to build as an entrepreneur? And so again, if you're saying, hey, I'm going after a really big market opportunity, and my goal is hopefully someday to try to be a public company, like a Facebook or like a, an Uber or a Lyft, then, venture capital actually can make a lot of sense for you because you're aligned. That means your objectives of trying to build a company are aligned with the objectives of what the venture capitalist is who's trying to fund you. I think where people get themselves into trouble is where they have misalignment of incentives. And there's nothing wrong with building a great business that may just never be a multi-billion-dollar business, but you can generate a great living for yourself and your employees and do all kinds of wonderful things. And if you want to go that path, the good news is there's things like, of course, banks that provide loans. There's even, kind of quasi venture capital things like crowdfunding and other things, which might allow you to raise smaller amounts of capital. So I think it's really that first question you have to ask yourself is what I'm building aligned with what incents the venture capitalist? And if so, then that partnership can actually be very profitable for both players.
No, that makes a lot of sense. The other thing you covered in the book that I thought was really fascinating that a lot of people don't think about, or at least in my opinion, don't think about, is actually building relationships with somebody that could potentially buy your company at someday, or maybe even you buy them, right?
Yeah, it's funny. When we invest in companies, of course, we want to believe they can all be public companies. The reality is, if you look at the data, only about 20% of the companies actually make it to an IPO. About 80% of the companies usually get sold at some point in time when they're lucky enough to have, a successful exit. And so what we talk about in the book is exactly that, which is it's a little bit, I hate to use the high school analogy, but it's a little bit like, when you're in high school, you want to get invited to the dance, even if you decide ultimately not to go to the dance. And I think about partnerships in that same way, which is when you start your business, you want to understand who are the other players in the ecosystem who might be valuable business development partners for you, or maybe at some point in time, they might be an acquisition candidate, for you to buy or potentially for them to buy you. And so you want to start to build those relationships because it's a real hard thing if you get to the end of the line and you only have a couple months of cash left in the business, and now you're for the first time trying to build relationships with some of those companies. So I think you can do that in a way that's effective for the company, that doesn't give away your competitive, spirit, or kind of give people information they don't need. But really think about it as just kind of building your set of relationships that may just be a safety net for you at some point in time, or quite frankly, could provide good business development opportunities for you along the way.
No, that makes a lot of sense. The other thing that you mentioned in the book, and you talk about quite a bit that I took away that I think a lot of people don't think about, is educating somebody like yourself on the VC side at how big the market is that I'm trying to go after as a startup or entrepreneur. So do you maybe want to elaborate on that a bit?
Yeah, let me elaborate, and then I'll give you an example. Hopefully
Sure.
it'll help illustrate it. But it goes back to kind of the first principles we talked about, which is if our job as venture capitalists is hopefully to believe this company can become a public standalone business, then we know it has to be in a market that can support a company of that scale. So that's really the foundational principle. And a great example, though, around the need to educate people on market, I'll use the example of Airbnb. So we're lucky enough to be an investor in that company. But when they first started, there was a lot of questions about how big the market was, because at the time Airbnb started, most of the use case was, in many cases, it was college starving students who were sleeping on other people's couches. That was really the market. And if you allowed yourself to get satisfied that that was really the size of the market, you might have decided never to invest in Airbnb because that's just not that big of a market. Probably the same size as the ramen market or the mac and cheese market. Those would be good proxies for other things that starving college students buy. But what Airbnb did a great job was they explained to people, hey, look, the way you have to think about this is the presence of the service actually can expand the market in a way that hadn't existed before. So even the hotel market would be too small of a proxy for how they were thinking about the business, because the hotel market presumes a certain level of cost that people have to have in order to stay there. It's limited, obviously, in many cases by geographic location, because it's expensive, obviously, to have hotels everywhere. And so what the Airbnb team did a great job was helping people understand how the application itself expands the size of the market. And I think today, if you look at the data, if you look at the number of nights, for example, that people stay in Airbnbs, it well dwarfs any of the largest hotel chains, because of this idea that the market itself has expanded alongside with the presence of the service.
Sure. Well, I think as somebody that's used Airbnb at this point, probably more times than I can remember, with having kids even, right? Like how many hotel rooms, well, small children have like a full kitchen, right? And it sounds maybe stupid to people that don't have kids, but if you need just certain like snacks for them, or you need a microwave to warm something up, or a full-size fridge, or like stuff like that becomes, you search that out, right? And so sure, Airbnb filled a huge need outside of that, but I think even just for people with families, it's like, well, I need all these things and I can get it, and it's a lot more cost effective in a lot of cases, at least in my own personal experience.
Yeah, I think you're absolutely right. And it has even the other, so that's kind of, it solves a demand need, right? The interesting thing about Airbnb, though, is that also you get increasing in market size as a result of the supply side of the business. And what I mean by that is people who might not have been able to afford going on vacations, now have a way to monetize effectively the excess capacity or unused capacity in their own homes. And that money then finds itself circulating often in the Airbnb economy. So yeah, it's a great example, I think, of exactly as you described, of where markets can just appear much, much bigger than initially you might think they are.
No, 100% agree. So in the book, you cover basically from the beginning to either IPOing or selling your company and everywhere in between. And obviously, we don't have enough time in this quick interview to cover all that, but you talk about roles of a board through the different stages of a company, which I found really, really interesting. And I, to be honest, never really thought about how in depth and how important a board is at the different stages and their involvement at the different stages. So do you maybe want to elaborate on that as well?
Yeah, sure. And as you saw, right, there's a whole set of chapters devoted to this because it's a really important topic. So the way I would think about how it evolves over time is kind of the board in all cases, hopefully, is a good advisor and kind of mentor and coach in some respects to the CEO. But I think where boards can go awry sometimes is they overstep their boundaries. And where this can happen is sometimes the board members themselves have been operators in companies before. So, there's a natural tendency as a board member sometimes to want to get more involved in the day-to-day of the business. And I think what good boards recognize is that the only way that they really affect the real day-to-day strategy of the business is by hiring or firing the CEO. And that's obviously not a role that the board takes lightly. But I think the kind of, the bad cases where boards kind of overstep and they start kind of, undermining, maybe inadvertently or otherwise, the role of the CEO in front of, her executives, or they are kind of trying to provide too much day-to-day guidance. And, what happens, when you're in this business, you realize over time, of course, is that no matter how close you are to the company, if you're at a board meeting, once a quarter or even once a month, you really have no idea the depth of execution and all the details that go around actually running the business. And so it's easy, I think, for you to kind of, romanticize that you might have more information than you actually do. But it's a real important role that the board plays. And I think really important, quite frankly, for the CEO to manage, her board in that respect and make sure that if she sees behavior like that where board members are overstepping, that you really have that conversation and make it very clear that, look, at some point you either believe or don't believe in what the vision and the execution capabilities of the CEO are. And if you don't, obviously there is, of course, kind of that ultimate, control the board has, which is to potentially change the CEO. But in the absence of that, they have to be really careful to support and not undermine the CEO.
No, I think that makes a lot of sense. So you quickly covered it earlier, but I really want to dive into Andreessen Horowitz and how do people actually go about getting investment from you guys? And then once they do, walk us through your services throughout the life cycle of working with a company, because you guys are very unique compared to a lot of companies that I've met in my career anyway.
Absolutely. Yeah. So let me talk about the initial phase, which is how
Sure.
do you get to us. So most of the deals we do get referred to us by somebody, kind of who we've, met at some point in the network. And so there are certainly some people who kind of cold email us, but a big piece of advice I would give to anyone who's an entrepreneur is, there shouldn't be that many degrees of separation, hopefully, from you to some connection into a venture capitalist. And that's a much better way to go. In fact, it's actually a good test of your mettle in some respects as an entrepreneur, because so much of what you have to do as an entrepreneur is be creative and be persistent and find ways, not just to financiers, but to customers and to employees. And so, working hard to find some warm introduction to a firm is a great place to start. And then the way we work with our entrepreneurs is once we make an investment in a company, the very first thing we do is we sit down with the executive team and we try to understand what are your goals for the next 6 or 12 months. And then we figure out, okay, great, here's all the places where we think we can help accelerate or augment your ability to achieve those goals. So I mentioned as an example, one of the big things we do for our companies is help them identify customers or business development partners who might be good, users of their products. And so we have kind of more than 1,000 what we call briefings annually in our offices here, where we're constantly bringing in large companies like a Home Depot or a Federal Express, and kind of effectively, kind of introducing them to portfolio companies that are directly responsive to the areas of technology they care about. And so we're doing that for sales and business development. We're doing that in terms of helping them identify new executives to bring on board and how best to find them. We have a marketing team that works very closely with our companies to help them make sure the story gets told and they, kind of have a direct relationship with all the appropriate reporters in their network. And so it's all those things that help accelerate the growth of the company, with one very big caveat, which is we have to remember kind of what I said on the board side is we don't run these companies, right? As much as we, want to see them successful, the biggest harm we can probably do to our businesses is to overstep that boundary between investor and trying to assume that we are inside the company. And so everything we're doing is kind of trying to accelerate the own efforts of the company itself, as opposed to trying to substitute for something that they would otherwise do on their own.
No, I think that makes a lot of sense. But I'm curious, do you guys help companies decide at what point they should sell or potentially think about an IPO? Or is that really up to the founders, or how does that kind of work?
Yeah, I think our job is to have the conversation with the company. Ultimately, it is, the founder's decision, in the sense that, we will never be able to force a company to go public, or we'll never be able to force a company to sell if the founder, and the founding team themselves don't find that attractive. But I think our job as a board member is to have the conversation and say, okay, are we achieving the objectives that we set out to achieve? And if so, and we're on track and we have the financing and all the resources to do that, and we think the market opportunity is as we expected, then, our advice probably is, look, let's keep going and let's try to kind of achieve that IPO or achieve some very, successful M&A exit. I think on the other side too, I think it is, part of the obligation we have sometimes to say, hey, it turns out that the market we were going after isn't as interesting as we all thought, or it turns out the product just isn't the right fit for this market. And while, of course, those can be challenging conversations to have, I find many times that's kind of the most effective conversation, kind of that VCs and entrepreneurs can have, because oftentimes what you find in those conversations is the entrepreneur in some respects is relieved to have that conversation, because they felt like, gee, I understood that and I believe the same things you believe, but I thought you as the venture capitalist kind of just wanted me to keep going and run through walls no matter what. And part of our obligation, I think, is to have those conversations and say, hey, look, maybe it's the best thing for you and for the company and the employees to recognize that despite our best efforts, we just may not achieve what we had set out to achieve.
Sure. Does the age of the fund ever factor into some of those decisions, or do you guys that's kind of your problem, not the entrepreneur's problem?
It's definitely our problem.
Okay.
But I would say, as an entrepreneur, it's important for you to understand that, because at the margin that can have some impact, right? So it's a great point. If you're at the end of a fund as a venture capitalist, and these funds tend to be kind of 10 years or so is typically what the terms are. If you're at the end of the fund and, either that fund is doing well or not doing well, that could have an impact on the venture capitalists, kind of thinking on how they want to position this company. Now, I certainly hope, and we would expect, for all of our partners, that we're always going to do the right thing regardless, but it's good to at least understand that as an entrepreneur and make sure you don't find yourself kind of at the mercy of a fund cycle, or potentially the inability of a venture capitalist to raise another fund that could impact the amount of capital they have to invest in the business. So I think those are all very fair and legitimate questions that an entrepreneur should ask when they're choosing a venture capital partner.
No, I think that's really good advice. So I'm curious to get your thoughts on the actual investment landscape right now, because obviously crowdfunding's been a big thing the last few years, and some people have had crazy success and others maybe not so much, and everywhere kind of in between. But where do you see the actual space maybe going in the next 3 to 5 years, if you have any predictions?
Yeah, for right now, actually, the market is what I would consider a very healthy market in that there's a lot of capital that's around in the market. So
Okay.
last year there was over $100 billion invested in venture capital backed companies. Now, a lot of that money is going into later stage companies, so you do see that phenomenon happening. But on the other end, on the seed stage, we've had almost 500 new seed firms formed over the last 10 years,
Wow.
which have done incredibly good things in the sense that it makes it much easier for experimentation and for new companies to get started. So as I look forward, I think a couple things are going to happen. One is I think that we continue to see just tremendous opportunity from the pure technology perspective. So despite the fact that we've been in a very good market for a number of years, we don't see entrepreneurs doing anything but incredibly interesting kind of cutting edge areas of technology, and I don't think there's any reason to believe that's going to stop. I also think capital will continue to be fairly abundant and readily available, so I think we will continue to see lots of experimentation happening. And then I think the other thing to just keep an eye on will be how long companies stay private. So we've been on a long kind of trend now for almost about 10 or 15 years, where companies used to go public about 5 or 6 years after they were started. Now it's typically 10 or 11 or sometimes 12 years later. And so I think that will continue to be the case where companies will stay private longer. And what that will mean is, therefore, I think you'll see continuous amounts of significant capital coming in at some of the later stages of the market. So, but overall, I think the conditions are quite good. Obviously, there's always macro shocks that people have to worry about. In the last couple of weeks, of course, we've been dealing with things like the China trade issues.
Right.
And anytime, of course, you have those macro shocks that impact the broader public markets, it will have some downstream impact on the private markets. But in general, kind of if you kind of put aside some of those macro questions, the fundamentals of the business actually remain very strong.
No, I think that's really good advice. But I'm curious, just because what you just mentioned, the last, maybe let's just say if the markets are unstable for months or even a couple of years, hypothetically,
Yeah.
your funds are 10 years, right? Ish, give or take, right? So people seem to just freak out, but that money's committed for the 10 years. I know this is probably an oversimplification, but you have 10 years to basically figure it out. And obviously there's going to be highs and lows in that and everywhere in between. But how safe is the investment? If you give me, say, $10 million for my startup and the market's up and down maybe in year 3 and 4 of that 10-year investment, should I worry? What's your thoughts around kind of that?
Yeah, it's a really good point, and I think it's very important for people to understand. You're right; these are very long-lived funds, and the way our funds work is our investors commit to us for that 10-year period, right? So we have the ability to draw that capital. So the way I would think about it is, look, if we get into a tough economic situation, what that means is for you as an entrepreneur is you have to think about, okay, when I need to raise that next round of financing, will there be any capital at all? And then number two, at what price, right? And I agree with your first point, which is that, obviously, we could have a major global financial crisis and that could really, kind of upset things. But in general, availability of capital shouldn't be the problem. There should be capital in the markets. The question will be, will people revalue businesses and, potentially, if something were valued at, some higher multiple of revenue today, maybe tomorrow, that multiple has gone down. And so you do have to be mindful of that as an entrepreneur, that you might accomplish a lot in terms of objectives for the business, but the market could have shifted to the point where the market just doesn't want to pay that same amount for progress. And so, that might mean, thinking more seriously about kind of valuation at which you can raise money. And then the second thing is just to think about kind of the fundamental business itself and how profitable is it at what we call the unit economics level. And what I mean by that is, you see some of these companies like an Uber or Lyft, obviously, that are growing very, very fast, but are also consuming a lot of cash. And so the question, that I think an entrepreneur should always think about is, if I'm taking that strategy and then cash becomes more tight because the financing environment has tightened up, is there a way where I can grow my business at a slower rate of growth, but at a higher level of profitability that allows me to extend the runway that I can use that cash for? And so I think it does put a premium on those types of operational issues that may not be as much of a premium in a time where capital is really free flowing.
No, I think that's actually really good advice, right? And I wanted to cover that because I think, well, selfishly, I was curious to kind of get your thoughts on that, but I think a lot of people worry about that, right? And I think just in general, as an entrepreneur, you always need to be creative no matter what kind of vertical you need to be creative inside your own business, right?
I think that's right. I think you want to look. The goal, of course, always is to win the market, right? I mean, that's always the ultimate goal. And I think you have to be mindful of the fact, as you say, that sometimes winning the market means, if you have more cash and more ability to spend money, that means growing hopefully at a faster rate and taking market share. But I think you also always have to have kind of in the back of your mind, kind of the plan B, which is, look, if I don't have as much cash availability, or if the cost of that cash is more expensive than I want to do, is there a way for me to still run my business, albeit potentially at a slower growth rate, that allows me to kind of achieve what I want? And then maybe when the market comes back and there's more cash, then I can kind of reaccelerate my growth. So I agree, as an entrepreneur, you're kind of always living a little bit in both worlds and being mindful of what the criteria are in each case.
No, that's actually really good advice. And sadly, we're out of time. And if people want, they can go to buildingthefutureshow.com and listen to the full interview, where we do a pretty good job, I think, at covering the whole gamut of what you cover in the book and what you guys do at Andreessen Horowitz. But for people that want to actually go buy the book and learn more about Andreessen Horowitz, where can they get more information to do so?
Yeah, so the easiest way to go is there's a website called secretsofsandhillroad.com, all one word. You can always, of course, also go to the A16Z website as well, and there's a book link there. You can pre-order now on Amazon. The book's coming out June 4th, as we talked about, and we're really looking forward to hearing feedback from the readers.
Perfect, Scott. Well, I really appreciate you again taking the time out of your busy day to be on the show, and I look forward to keeping in touch with you, and have a good rest of your day, man.
Thanks for having me. Take care.
Thank you. Bye.